Most people think the crash of 1929 happened because ordinary Americans lost their heads. A stock market mania of shoeshine boys and secretaries buying shares they couldn't afford, until the whole thing collapsed under the weight of its own foolishness. That's not wrong, exactly, but it's dangerously incomplete, because the mania wasn't the disease. It was a symptom. The real story of 1929 isn't a tale of foolish crowds. It's a story about a machine built out of borrowed money, 10% down and 90% debt, and about the man running one of the largest banks in America, who spent the better part of 2 years keeping that machine running, in public, while quietly protecting himself in private. His name was Charles E. Mitchell. The newspapers called him Sunshine Charlie, and the story of how he talked, financed, and finally lied his way through the biggest crash in American history is not a story about a bubble. It's a story about a man who understood exactly how the machine worked, because he was the one operating the controls. Now, I want to be clear about something before we go any further. The millions of Americans who lost their savings, their pensions, and their homes in the years that followed were not fools, and they were not reckless. Nothing in this video minimizes what they lost. But what most people never learned is what the man running one of the country's largest banks was doing behind the scenes, while telling all of them, publicly, to stay in the market. Let me take you back, not to the floor of the exchange on October the 29th, but to a spring morning 7 months earlier, in a wood-paneled office on the corner of Wall and Broad. This is the first thing historians tend to undersell. The Federal Reserve saw the danger coming and tried to act on it, and it was stopped, in public, by a single banker. Early 1929, the Federal Reserve Board was worried. Speculative lending, money loaned specifically so people could buy stock on margin, had exploded, and the Fed wanted the flow of easy credit into the market slowed down. In March of that year, the Fed signaled it intended to tighten. Call money, the short-term loans brokers use to fund their customers' margin accounts, briefly spiked as high as 20% interest, an emergency-level rate, as lenders got nervous and pulled back. And for about 48 hours, it looked like it might actually work. The market wobbled. Then Charles Mitchell stepped in. Mitchell was president of National City Bank, today Citibank, and one of the most powerful men on Wall Street. Announced, publicly, that National City would step in with $25 million in credit to the call money market, specifically to keep the borrowing flowing. It was a direct, public countermove against the Federal Reserve's own tightening effort, from a private banker, aimed squarely at the country's central bank. The market didn't just recover, it surged. Mitchell was celebrated in the press as the man who'd saved Wall Street from a panic. Nobody called it what it also was: a private banker using his own bank's balance sheet to override the one institution in the country whose actual job was to prevent exactly this kind of runaway lending. This is where the nickname comes from. Sunshine Charlie, always optimistic, always buying, always telling the country the boom had further to run. What the nickname obscures is that his optimism had a business model behind it. National City wasn't just a bank. It ran a sales division, the National City Company, with a network of salesmen in branch offices across the country whose entire job was to sell stocks and bonds directly to ordinary depositors. Under Mitchell, that sales force is said to have grown into the largest distribution network for securities in the world. Men on commission, paid to move product, calling on the same small depositors who trusted Mitchell's bank to hold their savings. The bank took the deposit at one window. The company sold the stock at the next. So when the Federal Reserve tried to slow the lending down, it wasn't just threatening speculators. It was threatening the engine of Mitchell's entire business. The deposits coming in the front door and the securities going out the back. And this is the second thing that gets lost in the popular version. The $25 million wasn't propping up the market in some abstract sense. It was propping up a specific, fragile mechanical structure, the margin lending system. And Mitchell understood that structure better than almost anyone alive, because his bank was one of its biggest suppliers. Here's how it worked. By 1929, an investor could buy stock putting down as little as 10% of the price in cash. The other 90% was borrowed, a call loan, arranged through a broker, secured by the stock itself. If you had $1,000, you could control $10,000 of stock. As long as prices kept climbing, everyone involved looked like a genius. The investor, the broker who arranged the loan, and the bank that supplied the money behind the broker. By the autumn of 1929, outstanding broker loans of this kind are estimated to have reached somewhere in the neighborhood of $8.5 billion, a sum that, at the time, exceeded the entire currency circulating in the United States. Every one of those loans was callable, meaning the lender could demand repayment at any moment, without warning. The whole structure was standing on debt that could be pulled out from under it in a single afternoon. And here's the part that made the whole structure more fragile than almost anyone in 1929 wanted to admit. The money behind those call loans wasn't only coming from banks. As interest on call money climbed into the double digits during moments of stress that year, 12%, 15%, briefly higher, corporations with nothing to do with banking started lending their own spare cash directly into the call market, chasing the return. Manufacturers, utilities, companies that made steel or sold soap, all became, in effect, part-time lenders to Wall Street speculators. Historians estimate that by 1929, well over half the money financing margin loans was coming from sources outside the traditional banking system entirely. If confidence cracked, none of those lenders owed anyone patience. Picture, and this next figure is illustrative, not one specific documented case. A bank clerk or a school teacher with a few $100s saved, walking into a national city branch and being introduced, one desk over, to a national city company salesman. Put down 10%, borrow the rest, and the numbers on paper only ever seemed to go one direction. That was the pitch playing out in bank lobbies across the country, and it was Mitchell's institution running both sides of the counter. Mitchell's $25 million wasn't rescuing confidence. It was refilling the fuel tank of a machine that ran on exactly this kind of debt, a machine his own bank helped build, helped finance, and helped sell to the public, one brokerage account and one bond prospectus at a time. National City Company salesmen were, by some later estimates, pushing hundreds of millions of dollars in securities a year onto ordinary customers, some of it, as would come out later, under oath, dressed up to look far safer than it actually was. None of this was hidden exactly. It was in the newspapers, in the financial pages, celebrated as sound and modern banking. What wasn't visible, what wouldn't become visible for another 4 years, was how the man selling the public on all of it was managing his own money on the side. This is the third thing, and it's the one most people get most wrong. The famous rescue of Wall Street on Black Thursday wasn't a market recovering. It was a stunt, and it worked for less than a week. Thursday, October the 24th, 1929. By 11 o'clock in the morning, the ticker tape, the paper strip printing out stock prices across the country, had already fallen nearly 2 hours behind the actual trading. Brokers on the floor were selling into a void, with no real idea what the last confirmed price of anything actually was. Outside, on Wall Street itself, a crowd had begun to gather, drawn by rumors that men were jumping from windows. None had. But the rumor tells you what the mood already was by lunchtime. 12:30, a small group of the most powerful bankers in the country, among them Mitchell, along with the heads of Chase, Guarantee Trust, and J.P. Morgan and Company, met privately at 23 Wall Street, the House of Morgan, a 5-minute walk from the chaos on the floor. Behind closed doors, they pooled roughly $130 million of their own institution's money. Then they sent word to the floor. The group didn't go themselves. They sent one of their own, a broker acting on their behalf, to walk onto the exchange floor in full view of the crowd. At 1:30, he stepped up to the post-trading U.S. Steel and bid $205 a share, several points above the last price anyone had actually paid. Then he moved on and did the same thing with a handful of other blue-chip names. It wasn't investing. It was theater, designed to be watched. If the country's most powerful banks were visibly buying, so the logic went, the public would stop panicking and buy too. Mitchell wasn't the man standing at the post. He was one of the men in the room who'd decided to send him, and for one afternoon it worked. The market clawed back most of its losses by the closing bell. The next morning's newspapers ran it as a triumph. The bankers had saved Wall Street. Mitchell's name was among the men credited. Here is what the headline missed. The rescue on October the 24th did not fix a single one of the problems it was covering for. The margin debt was still there. The call loans were still callable. The confidence had been manufactured in a boardroom, not earned. Friday and Saturday's shortened session held. And then, on Monday the 28th, the selling resumed, worse than before. By Tuesday the 29th, the day now remembered as Black Tuesday, the same bankers who had pooled their money 4 days earlier didn't attempt a second rescue. There was no fund large enough left to try. In 2 trading days, the market lost more value than the entire federal budget of the United States that year. The men who'd been praised as saviors on Thursday had, in reality, bought themselves 5 days. Mitchell had spent 7 months telling the country the boom was sound. He'd spent one afternoon in October trying to prove it with other people's confidence and his own bank's money. Neither bought what he was selling. And here's the final thing, one that took 4 years to surface, and the one that actually ended his career, and it has almost nothing to do with the crash itself. In early 1933, a Senate Banking Committee investigation, later remembered by the name of its chief counsel, Ferdinand Pecora, opened its hearings into Wall Street's conduct before the crash. Mitchell, still chairman of National City Bank, was called as its very first witness. What came out under questioning wasn't really about the crash at all. It was about December of 1929, 2 months after the market fell, when Mitchell sold a large block of his own National City Bank stock. He sold it to his wife. Stock had fallen sharply along with everything else, which meant the sale, on paper, produced a large capital loss, big enough, testimony revealed, to erase the tax bill on more than $1 million in bonuses Mitchell had personally received that same year. The result, for 1929, one of the highest-paid bankers in the country paid no federal income tax at all. The stock, by most accounts, effectively stayed within the family. Pecora's questioning didn't stop there. It surfaced a pattern of self-dealing at National City. Interest-free loans to Mitchell and other senior officers. Aggressive sales of securities to retail customers that hadn't been properly vetted. A trading pool in Anaconda copper stock that raised its own questions of conflict of interest. Newspapers across the country ran the testimony nearly verbatim. A sitting United States Senator, Carter Glass, the same Glass who would help write the banking reform law bearing his name that same year, said of Mitchell on the floor of the Senate that he, quote, more than any 50 men is responsible for this stock crash. Mitchell was indicted for tax evasion later that year. At trial, a jury found him not guilty of the criminal charge, but the government pursued him civilly for the unpaid taxes, and he was eventually forced into a settlement running into the millions of dollars. He resigned as chairman of National City Bank in 1933. The same year his testimony became front-page news across the country, not driven out by the crash he'd helped inflate, but by a stock sale to his own wife that he never expected anyone to read into the record. His testimony didn't end with him. The Pecora hearings ran for the better part of a year after Mitchell stepped down, dragging one banking practice after another into public record. And by the time they finished, Congress had passed the Glass-Steagall Act, separating commercial banking from the kind of securities business Mitchell had run, and created the Securities and Exchange Commission to police exactly the kind of sales practices that had put those bonds into small depositors' hands in the first place. The regulatory system built to prevent a second Mitchell was constructed, in large part, out of the record his own testimony created. Understand what that means. The men and women standing in breadline queues in the winter of 1933 had lost their savings to a crash Mitchell had spent years helping finance and defend. The thing that actually cost him his career wasn't that. It was a single tax return. So here's the paradox. It was all about a stock market bubble finally bursting under its own weight. And it was also about much more than that. It was about a system where the one man with the clearest view of the risk was also the man most exposed, personally, to the cost of admitting it existed. These two things aren't contradictory. They're complementary. The mania was real, but it was financed, defended, and sold by people who understood the mechanism perfectly, and who quietly arranged their own affairs as if they didn't believe a word of what they were telling everyone else. You can hear the echo of it today. Anytime the people running a financial institution are also the loudest public voices insisting everything is fine. And anytime the fine print of their own personal transactions tells a quieter, more careful story than their public statements do. The names change. The instruments change. Margin loans become something else. Call money becomes something else. The salesman becomes something else. The regulatory apparatus built after Mitchell's testimony, the SEC, the wall between commercial and investment banking, has been rebuilt, loosened, and re-argued about every decade since, usually by people insisting the danger it was built for could never happen again. The gap between what a person says in public and what they do with their own money in private has never once gone out of style. If this changed how you think about who actually caused the crash of 1929, consider subscribing. I make videos that look at the ledger behind the legend.